Okay, thanks again for everyone for coming here, and thanks to the panel for putting our paper on the program. It's really a great opportunity for me to present here. I'm a third-year PhD in finance from Yale. This is a joint work with Harry Mamaysky from Columbia University and Yiwen Shen from Hong Kong University of Science and Technology. So our paper is called Credit Information in Earnings Calls. This is an empirical paper that studies the dynamics of corporate credit risk. We will use textual analysis tools to extract credit-related information from earnings calls that help us better understand the current and predict the future risk. And I will show you how it works and why it works. So why are we interested in corporate credit risk? The corporate bond market in the US is growing and large in both absolute terms and relative to GDP. And as one of the primary channels for corporations to finance their operations, it is important for both policymakers and investors to understand the price dynamics in this market. And its understanding largely hinges on the assessment of future credit risk. So forecasting or explaining the credit risk is not a new challenge. Lots of great preceding research has set the ground for our analysis. For example, in a Merton type of model, some firm level characteristics are suggested to be crucial determinants, and there has been a strand of literature that trying to expand the list of predictors, and our discussant has a comprehensive summary of the list of these predictors in his recent great paper. But our observation is that there's some information left unaccounted for. So when investors evaluate the credit risk of a company, they ask some forward-looking questions. And by forward-looking questions, I mean questions like, what would the firm's business plan be in the future? What would firm's capital structure be in the future? So on and so forth. The challenge is these are hard to measure using CompuStat or using CRISP. But firms talk about this all the time in their earnings calls. So earnings call is an important channel for regular communication between the management teams and the investors. It also often happens on a quarterly basis and lasts for about an hour. Since it's both infrequent and relatively short, if the management team or the investors choose to bring up some credit-related information, it's likely that it is important. And oftentimes, it gives us some forward-looking insights that is valuable for our analysis. So here is a sample excerpt from an earnings call. Clearly, it provides us with some extra information. For example, the manager talked about their future capital structure plan. They said that they are confident that they can repair their balance sheet, and they have no current intention of issuing equity. Also, they provide some internal assessment of their liquidity condition, saying that they are at about the best shape in the past few years. But this information are not accounted for in the previous predictors. And what we do in this paper is we use textual analysis to unravel this information, and that will help us better gauge the current and the future level of credit risk. As an overview of what we do in this paper, based on the earnings call, we build a text measure, which we call credit score. I will specify this in detail when I introduce the text model. The credit score will capture the mispricing of the market credit spread relatively to a benchmark level derived from the call content. In other words, if the credit score is high, relatively speaking, the lower risk is suggested by our text model. And we find that credit score provides us with unspent predictive power, that it negatively predicts the movements of the future spreads. And so we go on and ask questions about the channel through which it predicts the spread changes. We document that our text measure forecasts lower risk in the future and better fundamental performance in the future. But clearly, investors are not taking all these sorts of linkages into account. Otherwise, the current spread would have already adjusted for the information embedded there. And so our credit score should not predict the dynamics of credit spread in the future. And so we ask another question, that is, why is the information not fully digested immediately after the call? And one explanation we have, which is consistent with our analysis, is the investors are capacity constrained to do so. In other words, there is a sort of rational inattention mechanism at play. Now, last but not least, we build an out-of-sample training strategy to document substantial economic value embedded in our measure. With appropriate leverage, our strategy will give us an annualized alpha of about 3.4%. So before I specify the text model and show the regression results, let me briefly talk about our data source and the data processing. The first data we need is the transcript data of the earnings calls, which are available from SB Global. So these are quarterly data from 2009 to 2020. Since these earnings calls, transcripts usually go to like dozens of pages. In order to identify the related information, we construct a list of credit words or phrases, and we focus our analysis only on the portion of the transcripts that are in the vicinity of the mentions of these credit-related terms. So this serves as a first-pass denoising process of our corpus. And in order to measure the credit risk, we use CDS spread, which is available from IHS Markit. We focus primarily on the 5-year contract because it comprises of over 90% of the sample. In terms of the timing, we match each earnings call with the market closing credit CDS spread on the same day that the call is held, if the call is held before the market close. Otherwise, we match it with the market closing CDS spread on the next day. So this will give us an immediate comparison between the market's evaluation and what is suggested in the call. So our main data will be a quarterly panel with roughly 250 observations each quarter. We also retrieve some data from standard sources, and this will, based on this, we will build the control variables in subsequent regression analysis. Also, before I dive into the tax model, let me specify how we measure the credit risk. We use the CDS spread because it's an accurate and sensitive measure of credit risk. And here we're just following the industry convention to use a totally equivalent measure, which is called the present value of loss given default. So PV-LGD is a dollar measure of credit risk. It gives a corporate bond's dollar discount to par with respect to a treasury bond with the same coupon and maturity. So it's totally one-to-one to the CDS spread and has the same directional implications. The higher the CDS spread, the higher the PV-LGD, and the higher the implied credit risk. Another way to think of it is it's analogous to implied volatility for option prices. And in the rest of the presentation, I will use the PV-LGD interchangeably with credit spread. So now we have all the ingredients. Let me put them into the tax model. So what we do in the tax model essentially we're estimating a map from the call language to the post-call level of market spread. And after we choose mapping and pin down all the parameters in the mapping for each earnings call transcript, we can generate a tax benchmarked value of level of credit spread, which is the implied level of spread. And then we can construct our main measure, credit score, as the difference between the market spread and the model spread. So credit score will capture the disagreement between the management teams and the investors' assessment of a firm's creditworthiness. We call it credit score because conditioned on the current level of market spread, the higher the credit score is, the lower the benchmark value suggested by the call content is. And in the rest of the analysis, we will use the credit score as a predictor to forecast the future change of the spreads, the fundamental variables, realized volatilities, so on and so forth. So the way we interpret it is it's an aggregation of the tax information that is misunderstood or not fully utilized by the investors. And this sort of encapsulation lends us the flexibility to, for example, interact it with a moderating effect so that we can draw some further insights. So there's one important component left unspecified there, which is which mapping should we choose. So we would like our mapping to have several properties. First, we want it to have interpretability so that we can do some granular word level analysis that will come in handy for the validation, so we're confident we're capturing the correct information. Also, we want to prevent overfitting because the observations we have is relatively tiny compared to the high dimensionality of the language. Also, we don't want it to be too data hungry because this is sort of a small corpus that we're operating on. So with all that in mind, Lasso is a simple and good match for us. And so our text model will be implemented with Lasso. And here is the reduced form equation of our model. The S here is the sector fixed effect that absorbs any sector-specific level of risk. And the beta here is the phrase level contribution to the current market spread. The way we represent the language is we build a document term matrix where each row of this matrix corresponds to earnings call. Each column of it corresponds to a word, and the element is just the word occurrence in the corresponding transcript. And we use a cross-validated Lasso to estimate the sector fixed effect, the word level contribution, so that we can have the benchmark call implied level of spread, and we build our main measure credit score. Another thing to note is we train our model on both full sample and with rolling windows. And the rolling window constructed credit score will be important when it comes to the out-of-sample trading strategy, which I will introduce at last. So we also train our model separately for investment-grade companies and high-yield companies to incorporate any differences in the language they use. So as an illustration of the Lasso estimates, here in the table, in the first column, we show some sample words. In the next two columns, we show their corresponding coefficients that is learned by the Lasso model on the IG universe and on the high-yield universe. Recall that the dependent variable is the current market spread, so a negative coefficient would suggest that the mention of the word is associated with a better credit condition. So the first row shows the words that are learned to have the same tone on the two samples. For example, if a company talks about growth, it's a good sign. It's learned to be a good sign for the credit assessment. But one thing to keep in mind is these are not causal relations. So if a company talks about growth 1,000 times in the earnings call, it doesn't mean that it's risk-free. So these are integrated effect, considering the co-occurrence of these words with other words and considering its context. So in the next four columns, we'll list the words that are learned to have different tones on IG and high-yield sample. For example, if an investment-grade company emphasizes they are investment-grade, that's learned to be a bad sign, but it's conducive for the high-yield company to do so, probably because they are used in the context where the rating will be upgraded soon. And in the last four columns, these are some placebo words that are totally shut down by the Lasso. So with all these estimates, we can now infer the call or the text model implied level of risk with the model. So here is the example I showed you before. The market says the PV-LGD should be 48.6, but our text model says instead it should be 35.6. So it gives it a credit score of 13, which is a good sign. So the next question to ask is, what can we learn from the credit score? Or equivalently, can the market understand that they are assigning too much risk to this firm such that they will adjust the spread lower in the future? And our conjecture is that they will, and in which case the credit score should negatively forecast the spread changes. And a related question is credit score providing us with new insights, or is just spanned by the existing predictors? And we will bring this to regression analysis. So the first specification we check is trying to explain the 12-month movement of the market spread using our measure credit score, conditioning on the current level of the market spread, which will incorporate some mean reverting pattern, potentially. Also, we control for some contemporaneous moves as specified by the Merton model. So this is used in the literature a lot. So they serve as a stringent test of any additional forecasters. We also control for the lag variables. So there are a long list of them, like 13 of them. And we cluster the standard error by firm and by time to have a more conservative inference. So here we show the results. The dependent variable, recall, is the 12-month change in the credit spread. In the rows, we show the explanatory variables. We omit the controls for readability. What we're doing here from columns 1 to 4 is we're progressively building up the set of predictors. So the first column would correspond to the benchmark Merton model. So we do this just for a sanity check. So it gives the coefficients which has the sign that is consistent with what was suggested by the structural model. And R square of in the first column matches with the previous documented results. In the second column, we add all the controls, and that beat up the R square a bit. And in the third and fourth column, we add the current level of spread and our measured credit score. So the takeaway of this table is there is a mean reverting effect in the spread, but controlling for that and controlling for a list of other variables, the credit score is still negatively associated with the future change in the credit spread. But what if we drop the contemporaneous explanatory variables and do a pure forecasting regression? So that is what we're doing here. We're forecasting the 12-month changes of spread conditioned on the information that are known at the time of forecasting. And what we found is still the credit score is negatively forecasting the change in the future credit spread, which means that the market is gradually gravitating to the level that our tax model would suggest. And hence, the mispricing is reduced gradually. In fact, about 20% of the mispricing is resolved in 1 year. And in terms of the economic value, if the credit score is high, it means the current level of PV/LGD is high. So an investor should sell the CDS contract to get the PV/LGD and wait for it to drop down and then buy it back to realize the gain as the difference. So this strategy will give her about 2 cents extra annual payoff per credit score per $100 invested. Okay, so taking stock, what have we learned so far? We build a tax measure based on earnings costs, and this tax measure negatively forecasts the changes of future spreads. And it suggests that there is a gradual correction in the market based on our measure. And so the next question to ask is, why can't it forecast the credit spreads, or where does this forecastability come from? And our conjecture is there must be some information embedded in it that links it to the future risk or the future fundamentals. And since there is this kind of linkage, if the market exploited ex ante, the spread would have already adjusted for it. And so there won't be any forecastability in our tax measure. So the second question we ask is, why isn't it reflected in the current spread already? So to answer the first question, we run a forecasting regression again, but we're forecasting the future risk and future fundamentals. To measure the risk, we use the realized volatility of monthly spread changes in the next year. And for the fundamental variables, we use some standard accounting measure for the change in profitability and in the leverage. And so here we tried some other horizons as well, but the results are qualitatively the same. And the conjecture here is the credit score should forecast a declining risk and improve fundamentals. And so that brings to tightened credit spread. And here we show the results. So this is more of a directional analysis. In the first column, we show that if the credit score is high, in which case our tax model says the firm's credit condition is healthy, then the spread, the firm's spread will be less volatile in the future. We see that the current spread level forecasts more risk in the future, which is not surprising because it is itself a measure of risk. And in the next two column, we show the forecasting results for the fundamentals. The takeaway is if the tax model says the firm is in good credit condition, then in the future it will operate with more profit and with less leverage. So another thing worth noting is the spread level itself doesn't forecast the fundamentals, which work as another verification that there is some unique information embedded in our tax measure. And so what we do here, we use our credit measure to forecast the risk and fundamentals, and we find that there is a forecastability on these quantities. So these are some potential information that is embedded in our measure. But investors are not fully taking them into account. Otherwise, the spread would have already adjusted for it. So the next question we ask is, why aren't that information fully digested initially? So here we're forecasting the spread changes again, but with a little modification. That is, we add a moderator effect to the credit score. The moderator is aimed at measuring the information complexity. So our conjecture is if the information is too complex, it will be a hard time for the investor to identify and to decipher the credit-related information. So we use two measures. The first one is a simple yet intuitive one, which is the length of the transcript. The idea is if the transcript goes on for too long, it will be hard for the investor to locate the key information. The other one is used in the accounting literature as a proxy for the complexity of the firm's business. That is the number of analysts covering the firm in the past year. So intuitively, if the firm business is complex, it will attract more analysts together and compete to sort of decode the information in their communications and so on and so forth. And so the conjecture we have here is investors are capacity constrained, in which case the parameter of the interacted term should have the same sign with the credit score. The reason is for a capacity constrained investor with the same amount of time, he will learn lower percentage of information if he is facing a more complex message compared to if he is facing with a more simpler message. So here we show the results. In both cases, we find that the result is consistent with our conjecture that the coefficient of the interaction term is negative. In the first column, if the firm business is more complex, then the correction of the credit coming from the credit spread will be more. And in the second case, if the firm is associated with a longer transcript, the reverting to the benchmark level effect will be steeper in the future. In terms of the scale, if the firm is associated with most analysts or the longest transcript, the correction effect will be swelled up by about 50%. In other words, the complexity of the firm business and the length of transcripts impede the investors from fully comprehending what the management team is intended to convey. And so we see this as supportive evidence that investors are capacity constrained so that the information is not fully reflected from the beginning. So what have we learned is our tax measure forecasts the future movements of credit score, probably because they can forecast changes in future risk and fundamentals, and investors are not fully capture them initially because they're capacity constrained. And the last question we ask is, what is the economic value embedded in our measure? And this is when we build a pure out-of-sample strategy to try to document the returns. So this strategy is built based on the rolling sample estimated credit score, which means that this strategy is available to all the investors in the market. The central logic of this strategy is that we are maximizing the total mispricing of the portfolio or the total credit score of the portfolio, and we will benefit from the from the reverting effect or the correction effect we find in the regression analysis. So the idea being that if the credit score is positive, it means the current level of PV-LGD is too high, so investors should short the CDS and buy it back later to realize the gain. And vice versa, if the credit score is negative, she should buy it now and short it later. So essentially what we're doing here is we're longing the cheap credit and we're shorting the expensive credit. And we operate this strategy with some constraint. First, we want it to be self-financing so that it can give us a pure excess return, and it's more like market neutral. And we don't want it to be too concentrated on a single name, and so we put this limits on the weight allocation we will put on any, like there's an upper bound and a lower bound and a single contract. And this will, to some extent, diversify our portfolio. The last constraint we put in the strategy is we set a leverage limit on both short side and the long side. And so this will make it applicable in practice. So here we show the annualized excess return of the strategy for the IG portfolios. So what the matrix shows is in the column, we have the upper bound of the allocation that we set on any single names, And in the rows, we have the lower limit of such weights. So the stars in the matrix are coming from a bootstrap analysis, which is we solve the optimization problem every month, and we have the optimized weights and contracts. We shuffle the corresponding between them, and we have a distribution of return based on which we can do the inference on the real return. So the takeaway of this matrix is the strategy is delivering a significant and positive excess return in almost all cases. As a benchmark from 1972, the annualized return of long-only investment grade portfolio is 7.14%. So if one is going to implement our strategy on top of that, that will beat up the return by about 50%. The high yield portfolio delivers a similar excess return, but we're not showing them here. And this result also speaks to capacity-constrained investors, because if they are aware of the signal ex ante, they would have already exploited it. And we won't see this positive and significant returns here. Okay, so let me conclude. What we've done in the paper is we use textual analysis to construct a measure based on earnings cost that measures the mispricing of the market relative to a benchmark level. And we find it provide us with unspent predictive power that it negatively forecasts the future involvement of credit spread. And 20% of the mispricing will get resolved in 12 months. And where does this correcting pattern come from? First, we find that the credit score forecasts lower future risk and improved fundamentals. And so the investors are learning gradually from this information. And the reason why they cannot learn it immediately after the call is because they are capacity constrained. And lastly, we build an out-of-sample portfolio to document the substantial economic value embedded in the credit score. That will give us an annualized alpha at about 3.4%. And with that, I'll conclude my presentation. Thanks a lot for your time, and thanks in advance for Mark's discussion.